Today's market story is not a simple one. It is not just about inflation. It is not just about bonds. And it is not just about oil. It is about all three hitting the market at the same time. Inflation is heating up again. Long-term bond yields are under pressure. And the oil risk around the Hormuz Strait is keeping global markets nervous. That combination matters, because when inflation stays sticky, central banks cannot relax easily. When yields rise, borrowing costs go up, and when energy risk rises, the inflation problem gets worse again. That is the setup investors are facing now. The first issue is inflation. In Australia, headline inflation has climbed again, with the latest data showing a sharp move higher. The Reserve Bank has already reacted by lifting the cash rate to 4.35%. That matters because it tells us inflation is not fully under control. The RBA is still worried about price pressure, especially with fuel and commodity costs feeding through the economy. This is not the kind of inflation that disappears quietly. It is the kind that stays in the system, pushes up services prices, and keeps policy tight for longer. Now let's look at bonds. The bond market is sending its own warning. The 10-year Australian government yield has moved close to 5%, and the 30-year part of the curve is also under pressure. In the US, long-term Treasury yields are still elevated as well. That is important because long yields drive the cost of mortgages, corporate debt, and government borrowing. When those yields stay high, the pressure spreads beyond the bond market itself. This is one of the reasons markets get uneasy so quickly. Bond yields are not just numbers on a screen. They are a signal that investors are demanding more compensation for risk. And right now, the message is clear. Risk is not cheap. The second issue is debt and household pressure. When rates rise and stay high, households feel it first. Mortgages become harder to manage. Refinancing becomes more expensive. Credit card debt becomes more painful. And living costs stay elevated at the same time. That is a difficult combination. Businesses also feel it. They face higher funding costs, weaker confidence, and more pressure to pass on prices. Governments feel it too, because higher bond yields make public debt more expensive to service over time. So even if the economy does not look broken today, the strain can build in the background. That is why this kind of inflation cycle is dangerous. It does not need a sudden crash to do damage. It can slowly tighten everything. Now let's move to oil. The Hormuz Strait is still one of the most sensitive pressure points in the global economy. If shipping through that route is disrupted, oil prices can move fast. And once oil moves sharply higher, inflation usually follows. That is the part markets fear most. This is not just about geopolitics. It is about the real economy. Oil flows into transport. Transport affects food. Food affects headline inflation. And headline inflation affects central bank policy. So a shock in Hormuz can spread much further than the initial headlines suggest. And that is why analysts keep saying the current risk is not a normal one. The supply buffer is weaker than many people think. That means the market may have less room to absorb a disruption than it had in past crises. In other words, the world does not have a lot of spare capacity to hide behind. So what does this mean for the broader outlook? It means the market is dealing with multiple warning signs at once. Inflation is still sticky. Long-term rates are high. Debt pressure is rising. And oil risk has not gone away. Any one of those would be enough to worry investors. Together they make the setup much more fragile. That is why the bond market deserves close attention. When yields rise this far and stay there, it often means the market is pricing in a tougher path ahead. That could mean slower growth, more policy tension, and more stress across asset classes. It is also why recession risk cannot be dismissed. The economy may not be collapsing, but it does not need to collapse for damage to build. It only needs to keep absorbing shocks with less and less margin of safety. That is the uncomfortable truth. The latest Australian inflation data, the RBA's response, the move in long-term yields, and the Hormuz risk are all pointing in the same direction. The environment is less forgiving than many hoped. Today's message is simple. Inflation is back on the radar. Bonds are under pressure. Oil risk is still alive. And the market is not in a comfortable place. This is not the moment to assume the danger has passed. It is the moment to watch the signals closely. Because the next move could come from the bond market, the energy market, or the next central bank reaction. And when those three are moving together, the market usually does not stay calm for long.